All right, hi everyone. My name is Kyle Robbins. We're going to go ahead and get started. And there we go. Okay. So yeah, welcome to our presentation today. Like I said, I'm Kyle Robbins. I'm an audit partner here at Larson & Company. Presenting with me today is Richard Scoresby. He is a tax partner here at Larson & Company. And today we're going to be covering the financial and tax reporting requirements for in-kind contributions. So as far as the audit side goes, there was a recent accounting standards update that went out for this type of reporting. And so I'm going to cover some of that, and Richard's going to cover just the general 990 reporting requirements for in-kind contributions. Before we get started though, just want to do a couple of housekeeping items. We have more than 30 participants today. We're excited to answer as many questions as we can. So in order to take your questions, there's kind of a way we're going to be doing that. So right now everyone's muted except for the speakers. If you happen to have any questions during the presentation, you can type those into the Q&A box. And that Q&A box is visible down at the bottom of the screen, the Zoom control panel screen. So you should be able to see that when you look down there. If you have any problems finding that and you have questions come up, feel free to reach out to me and Richard via email. We're happy to respond to any questions you have that way as well. The presentation is being recorded, and so it will be available on our website at the end of the presentation. But as far as CPE requirements, if you view it over the website, it won't be eligible for CPE. In order to get CPE, we do have to track attendance, and then we will have some poll questions. I'll talk a little bit more about that. And then we do like to point out that, accounting standards do change. So what we're presenting today is as things stand today. There could be changes in the future. If any changes come out, we do try to keep our clients updated on that. But so what we are presenting today is as of today. So as far as CPE goes, there will be 5 poll questions throughout the presentation. So you do need to respond to those. They'll be fun questions, I'm sure, and no sarcasm in that. And then at the end also, we do require that you submit an evaluation form. So that will go out to all participants. Just fill out that form and respond to that form, and that will help you get your CPE as well. And then once we get that back, we're able to verify participation. We will be sending out the CPE forms within the next 2 weeks. Shouldn't take too long. And then, like I mentioned, if you have any questions on CPE, you can put those in the Q&A thing as well, or you can go ahead and send us an email and we can respond to those. If you have any problems with the polling, not being able to answer that, feel free to reach out via email and we will help resolve those issues as well. Okay, not really getting into it yet, but just kind of a brief background on Larson & Company. We started in 1975. We were founded by Dennis Larson, and we have worked on nonprofits since our inception. Some of the first nonprofit clients we had at inception are still clients today. We do have a large nonprofit audit and tax team. We do work with over 80 nonprofit organizations, and those organizations vary in size, and a lot of them are located throughout the state of Utah. As you can see here, I put in our office locations. We have Salt Lake City office, Spanish Fork, Moab, and St. George. And so our main office is our Salt Lake City office, but all of our offices are able to help service nonprofit clients, specifically tax, but then our audit department can also service nonprofits throughout the state as well. Okay, we'll go ahead and I mentioned, Q&A as questions come up. I do have some slides set aside to specifically look at some questions that have come up and address those at those times. So we'll go ahead and get started. We're going to start with the tax reporting for in-kind gifts. And Richard's going to take that over for us.
All right, good afternoon, everyone. Good to be with you today. Go ahead and change the next slide, Kyle. We're going to briefly be talking about, over the next 30 minutes, two main topics: non-cash contributions. When we speak of in-kind gifts for tax purposes, the tax forms refer to non-cash contributions. So we're going to talk about that definition and what that includes. And then we're going to do a quick but comprehensive overview of where to report non-cash contribution information on the 990 and on all of its schedules. When I say comprehensive, I mean in breadth of comprehension, but not depth. We won't have a time to get into a lot of detail on some of the topics, but hopefully this will spark some questions and make you just ask yourself whether or not you're reporting everything properly and correctly on the 990. I was surprised as I went through this how many places the 990 forms refer to non-cash contributions. Go ahead and next slide, Kyle. So the definition of non-cash contributions for reporting on the 990 is contributions of property, tangible or intangible, other than money. So it includes all types of property. The main difference between contributions for reporting on the tax forms versus for financial statement purposes is contribution of services are not reported on the tax forms. Go ahead and change the slide. The definition also gives a list of things that are included, but they make the caveat that this is a list, but it's not limited to these items. However, I think they've tried to do a really good job of identifying all the common things that can be contributed to organizations. And I think it covers pretty much everything. However, there is a way out, they say, but aren't limited to, so that gives them the option if they forgot something. They can always say, oh, you should have included that too. So here's a list: stocks, bonds, and other securities, real estate, works of art, stamps, coins, and other collectibles, clothing, household goods, vehicles, boats, and airplanes. Next slide. Inventories of all types, intellectual property, including patents, trademarks, and copyrights. It also includes donated items that are sold immediately after they're received, such as publicly traded stock, and also used cars, for example, and items donated for sale at a charity auction. It's another thing they mention. I know some organizations I've been aware of try to keep things simple. So if they receive donations of stock, for example, and their policy is usually to immediately sell that stock. And so I've seen some organizations treat it as if it's just a cash contribution. They haven't tracked those separately, but to follow the rules for tax reporting purposes, you should separate those and report donations of stock as non-cash contributions. Next slide. Non-cash contributions, as I mentioned, don't include services, volunteer services performed for the reporting organization. It also doesn't include the donated use of materials, facilities, or equipment. Next slide. I'll just give you some examples of what this could include. Examples of donated services include legal or other professional services, free advertising I've seen quite a bit being provided to nonprofit organizations, medical or dental services. As an example, a nonprofit who provides medical or dental services to low-income families or third world countries may engage doctors who volunteer their time and expertise to providing those services. That's one example there. Go to the next slide. Examples of donated use of materials, facilities, or equipment. I was trying to think of how materials might apply. I was thinking most materials that are donated are probably used up by the organization in some manner, but one idea I had was perhaps if somebody donated items for a display, for an exhibit for something, maybe you guys can think of other things where materials might apply. Most often I see donated use of equipment or facilities such as free rent being provided to the organization. Sometimes I've seen for fundraising events, you know, donors will offer up their cabin, for example, to be used for a week, and they'll allow the organization to auction that off. Use of audio-visual equipment for an event could be an example. Also, travel vouchers or gift cards issued by a business that's providing the service. And I underline service there for a reason. This area of gift cards and vouchers and things like that can be a little confusing, but I think kind of where you need to draw the line is, for example, with a gift card, if a donor actually goes out and buys a gift card and pays cash for that gift card and then donates that to the organization, I would consider that a donation of property. If a company like Lagoon, for example, has a gift card that allows someone to come and enjoy the park free for a day, that would be a donation for the use of facility. Lagoon isn't actually doing anything different by they've made no cash outlay to allow that person to come into the park for a day. They can just come in and use the facilities for a day, and that would be considered a donation for use of facilities. Another example would be travel vouchers. I remember an organization I was familiar with that received thousands of dollars worth of airline vouchers that were donated for flying, and they were issued by the airline. And so in that case, that would be a donation for use of their equipment or facilities. But if a donor, again, went out and bought a travel voucher, expended cash for it, and then donated that to the organization, I would consider that a donation of property. Next slide. Okay, I guess we have a polling question. And there it is. Using your best estimate, how much does your organization receive in non-cash contributions each year? 75% or more? Between 50 and 75%? Between 25 and 50% of total contributions, or less than 25%? Or if you don't get any, just put NA. All right. Oh, there's your responses. Looks like the majority of you receive less than 25% of your total contributions as non-cash contributions. And a third of you don't receive anything usually, so interesting. All right, let's move on. All right, we're gonna move forward and talk about all the different places where non-cash contribution information is required on the Form 990 and its schedules. As we go through this, you just might ask yourself the question, does my data collection and reporting system gather the necessary information for reporting on the Form 990? I think the new accounting standards that Kyle will talk about later, which require a little bit more disclosure, will be helpful for preparing the Form 990. I think the 990 has been ahead of financial reporting standards for the information that is required for non-cash contributions. So I think that will help in making the preparation of the 990 easier going forward. Next slide. The first part where it could come up where you may consider reporting information about your non-cash contributions is in part three, program service accomplishments. This particular area doesn't necessarily require you to report anything, but if your organization receives a significant amount of donated services or use of items that otherwise aren't going to be reflected in the financial numbers on your tax form, you may want to provide that information in your program description. I mentioned an example of doctors providing medical services, perhaps in a third world country or to low-income families. That could be a significant part of a nonprofit's program, and all of their time and expertise wouldn't be reflected in the financial numbers on the tax form, but providing that information as part of your description for what you accomplished during the year would be a good place to put that. Next slide. On Form 90, Part 4, it's a checklist of required schedules. There's a couple of pages of numerous questions that are asked, and there's some that refer to non-cash contributions. The first one we come across is line 7. Did the organization receive a conservation easement? And I'm sure this doesn't apply to most of you who are listening, but that's something to be aware of. There's been a lot of abuse with the overvaluing of conservation easements, and the IRS is well aware of it. So there's lots of disclosure that's required in relation to these conservation easements, and there's been a lot of court cases that have contested the value of what a donor is trying to take as a deduction on their tax return. Another question is line 8. Did the organization maintain collections of works of art, historical treasures, or similar assets? If so, you need to report more information on Schedule V, and the same for the conservation easements. Generally, if an organization is of this type where it maintains these types of assets, they usually receive those as contributions periodically from donors. Next slide. The next question on Part 4 is line 29, and it asks, did the organization receive more than $25,000 of non-cash contributions? And if so, if you answer yes, then you're required to complete Schedule M, which we'll talk about later a little bit. But keep in mind, if you receive $25,000 of contributed services, for example, but not of actual property, you would not answer this question. Yes, you'd answer it no, since, again, services aren't reported on the 990. And then line 30, did the organization receive the contributions of art, historical treasures, and so forth that we talked about a minute ago? Again, if you answer yes to that question, you're required to complete parts of Schedule M. Next slide. All right, line 7C in this, we're moving on to Part 5 of the 990, where it has statements regarding other IRS filings and tax compliance. And line 7 specifically refers to organizations that can receive deductible contributions, which would apply to 501c3 charitable organizations. And the first one is, did the organization sell, exchange, or otherwise dispose of tangible personal property for which it was required to file Form 8282? If you receive large contributions of property, you should be aware of Form 8282's filing requirements. And if you have filed Form 8282s, you're supposed to indicate the number that you filed during the year. Go ahead and go to the next slide. If you don't know what Form 8282 is, it's a donee information return form that the donee organization is required to file in some cases when they receive what's called charitable deduction property. So that's any donated property other than money and publicly traded securities if the claimed value exceeds $5,000 per item or group of similar items donated by the donor. It's important to note that sometimes people are confused and think they have to report publicly traded securities, but that's not the case, thankfully, because that's a very common way for donors to make contributions to organizations. But if someone had an ownership in a privately held company, stock or an ownership interest, and they wanted to donate that, then you would be required to file 8282 if after you received that donation, you disposed of it. And this also mentions, this is property that should be listed in section B on form 8283. And that form is the form that the donor should file with their tax return when they've made a large donation of property in order to qualify for the tax deduction. And filing this form is required. There's been many cases where people haven't properly completed that form or included all the necessary signatures on it, and large donations have been denied by the IRS for not completing that properly. So often when a property is donated, it requires an appraisal and certification by an appraiser, and the donee organization also needs to sign off on the form. And as a good practice, it's good to keep a copy of any form 8283s that you do receive, since that information will be important for help in filing the 8282. Next slide. As far as the filing requirements, if you receive property and you hold on to it and you haven't sold it within 3 years, you don't need to file the form 8282. It's only if you sell it within 3 years after receiving the property. And you may ask what's the purpose of this form? It's kind of provides a check on the fair market value being claimed as a deduction on form 8283 by the donors. It's to prevent them from taking a larger deduction than they probably should. And the way the IRS can compare that is if someone files a form 8283, for example, and they list the property value at $1 million, and they donate that to an organization, and the organization turns around and tries to sell that property for fair market value within a short period of time, but say they can only sell for $500,000, they'd have to report that information on the 8282, and then the IRS could use that as a means to compare what was taken as a deduction versus the value that was actually obtained by the organization. And it could be a cause for the IRS to do a little further checking in that charitable deduction that was taken. Next slide. All right, another question about compliance on Part 5 of the 990 asks if the organization received a contribution of cars, boats, airplanes, or other vehicles, and did you file a Form 1098-C? Hopefully, if your organization accepts these types of donations, you're well aware of what a Form 1098-C is. But if not, go ahead and go to the next slide. It's just a form that's required to be filed with the IRS for each contribution of a qualified vehicle that has claimed value of more than $500. And it also discloses different information about the donor and the vehicle. And again, the purpose of this form is to prevent donors from overstating the value of their donations. A few years ago, when car donation programs started to become really popular, the IRS started noticing that people would donate cars and take an unreasonable deduction amount on their return. Just as an example, people could donate a worthless car on their tax return. They'd try to claim a large deduction for that car, even though the charity could only sell it for scrap value to a junkyard, for example. So this is just a way for the IRS to help stop that kind of abuse. Because if an organization, if someone tries to claim $1,000 deduction for a car that the charity could only sell for $250, then there could be a problem with the value of the deduction they're taking. Next slide. All right. Line 7G says, if the organization received a contribution of qualified intellectual property, did the organization file Form 8899 as required? And I have to admit, I did not know what 8899 that form was before I was preparing for this presentation. I've never worked with an organization that received a contribution of qualified intellectual property, so I was not familiar with this requirement. But I did look it up. If you want to go to the next slide. It's a notice of income from donated intellectual property. And it's used by the donee to report net income from qualified intellectual property to the donor of the property and to the IRS. And it seems like a real pain to me, but the form must be filed for each tax year that the donee, in which the donated property produces net income. And it's possible that you could have to file this form for a period of up to 10 years. So something to be aware of. I don't think it's really common, but sounds to me like a 10-year reporting requirement might be kind of a pain. Next slide. All right, we're going to move on to part 8, the statement of revenue on the 990. And up in the revenue section and in the contribution section, there is a line item where you're supposed to disclose the amount of non-cash contributions that were included in your total contributions received for the year. That goes on the line 1G there. Next slide. Also on the statement of revenue, line 8A and B, this is gross income from fundraising events. I put that here too because oftentimes the non-cash contributions are an important part of some fundraising events. So this information here on part 8 usually flows from Schedule G, where you disclose more information about those fundraising events. Next slide. All right, on the statement of functional expenses, there's, when you receive a non-cash contribution, you're generally recording it as a revenue item and a corresponding expense item, unless it's some type of asset that was contributed that will be included on the balance sheet. But if it is an expense item, there are numerous places it could end up on the statement of functional expenses, depending on the type of contribution it was. For the sake of simplicity, I love it when organizations have a separate account where they put all their non-cash contribution revenue items and expense items. Makes it really easy for reporting on the 990. We usually put those down on line 24, other expenses. Something to keep in mind if you aren't doing that. Next slide. Again, a non-cash contribution could be a contribution of an asset, and if so, it would need to be recorded on the balance sheet. And it could go in different areas. If, let's say you did receive a contribution of stock and you didn't have the policy to immediately sell it, it could be listed as public support or public securities on the balance sheet, or it could be listed as land, equipment, or if you did accept intangible assets, it could go there on that line item on the balance sheet. Part 11 of the 990 is the reconciliation of net assets, and there is a line item on this schedule that says donated services and use of facilities. I personally have never used this line, and I'm not sure what the purpose really is. I haven't been able to think of a scenario where you would need to use it, because typically when you're if you're reporting non-cash donated services, for example, on the financial statements, you would have recorded the income and a corresponding expense. And if you back those items out of reporting on the tax form, you're taking them out of both revenue and expenses. So they become a wash. So they really don't need to be a reconciling item. So, but just something to be aware of. Maybe I'm just not thinking of a case where this might apply. Next slide. Okay, we've been through the Form 990. Now we're moving on to the schedules. And the first place where it could pop up is on Schedule A, Part 2, Support Schedule. On line 3 of that schedule, it says the value of services or facilities furnished by a governmental unit to the organization without charge. And then it says, don't include the value of services or facilities generally furnished to the public without charge. So it's specifically designed for something that's just specific to your organization. And the neat thing about this is, even though it's not reported in your income or your expenses, it can be included on this schedule, and it can actually help your public support test by being put on line 3. I do know of one organization that is allowed to use a government building rent-free. It's a large building, and we don't report the revenue or the expense on the 990, but we do report the value that they receive each year on this line item, and it actually is a fairly large amount. So if this may apply to your organization, be sure to capture that information and use it on your support schedule. Next slide. All right, and this is just a sample of where that's reported, right at the top of the public support schedule. And you can list it out for each of the 5 years that are listed there on that schedule. Go ahead and go to the next slide. Next schedule where non-cash contributions comes up is on Schedule B, Schedule of Contributors. This is where you have to provide more detailed information on your large donors. And if they happen to have made a non-cash contribution, you would check the box over under column D, non-cash, and then it refers you to part 2. Next slide. On part 2 of Schedule B, you just have to provide more information about what was donated from the non-cash property and provide a the fair market value of that property and the date received. Next slide. All right, the next schedule that applies, and these were referred to earlier, conservation easements would go on, more detail would go on Schedule B, Part 2. There's quite a lot of questions that need to be answered if you do receive a conservation easement, and that's lines 1 through 9. Next slide. Same thing with the organizations that maintain collections of art, historical treasures, or other similar type items. There's a section on Schedule D with 5 questions where you're required to provide more information on the assets that you're holding or the assets that you received during the year, the reporting period. Next question, or next slide. On part 11 and 12 of Schedule D, if you received an audit of your financial statements for the year, you're supposed to complete this reconciliation. And what it does, you're reconciling the income and the expenses from the audited financial statements back to what's being reported on the Form 990 for the revenue and expenses. And there is a line item. If you did receive contributions of donated services and use of facilities, you need to report that as a reconciling item on the schedule, and it goes in the income section and as well as the expense section, and they usually offset each other. Next slide. We mentioned Schedule G earlier for fundraising events. As part of your gross receipts, if you are receiving non-cash contributions, you should include those as gross receipts and also then back them out as contribution portion of the gross receipts for your event. The non-cash prizes may also come into play because some of those contributions that are made may be given away as prizes to those who attend your event. So that line 5 may apply also. Next slide. Schedule M is the schedule for providing the most detail on your non-cash contributions. Again, this applies if your organization received more than $25,000 of non-cash contributions during the year. They provide a whole list of different types of items that you may have received. And as you can see, you check if it's applicable and you record the number of contributions or items that were received during the year. You'll notice on line 4 and 5 that is, and column B, that part is grayed out. Because of the enormous amount of items or contributions some organizations receive, the IRS has said you don't need to provide information that information on the numbers you receive if you get books and publications or clothing, other household goods. And then if you're determining the method of non-cash value, you just need to put more description on how you valued it. And finally, here's another list of items, and there's places down below. If something doesn't apply on line 25, you can always add in your own description. Next slide. There's also some informational questions down at the bottom of Schedule M. Line 29 asks the number of Forms 8283s that were received by the organization during the tax year. We talked a lot about that earlier. So if you received any during the year, you're supposed to report the number that you received here. Line 31 talks about a gift acceptance policy. If you don't have a gift acceptance policy, it'd probably be a good idea to get one in place. Just so when that, at some point you may have a donor who wants to contribute something really exotic or unusual, you want to have a gift acceptance policy in place so that you can fall back on something to say, no, we do not want that. Also, I mentioned, does the organization hire or use third parties or related organizations to solicit, process, or sell non-cash contributions? The most I've seen this is if organizations have, for example, a car donation program. Oftentimes, just to do all the administrative work that's involved, they do hire outside third parties to handle that for them, and of course pay them a fee for doing that. But if that was the case, you'd answer yes here and provide more information in part 2. So that's a quick rundown of all the different places on the 990 and its schedules of where non-cash information could be reported. Again, just a reminder, you might just consider, if you're not capturing all this information through your regular data collection and reporting processes, you might consider making some changes so that you can report it properly or easier when it comes tax time when you're trying to prepare your form. And next slide. And that's all I had for today. I apologize, I have to run now, but like Kyle said, I'd be happy to answer any specific questions that you have for your organization. Feel free to email me anytime and I'll try to respond as soon as I can. But I think that's it for me. So I'll turn the time back over to Kyle, I believe.
Great. Thanks, Richard. All right, now that Richard's covered the tax piece as far as in-kind contribution reporting goes, we're going to go ahead and get into the financial statement reporting requirements. So I have 3 areas I'm going to cover. So the first one is kind of a background on gifts in kind, and I know Richard talked about some of these, so I'm going to focus more on the financial reporting aspects. There might be some overlap, but hopefully there won't be too much there. Next, I'm going to talk about the updates that recently came out to the reporting requirements for in-kind contributions. This is probably why most of you are here, to kind of get some information on what's going to be changing and kind of when it's going to be changing and maybe a little bit of the why. So we're going to cover that. And then last, I'm going to go through some specific examples of financial statement presentation and disclosures to kind of show you, okay, the standard says this is changing, what actually is affected from those changes. So we'll go ahead and get started on this. So a quick background on in-kind contributions. So just kind of like Richard talked a little, some about this of what the definition of gifts in kind are. So essentially they're contributed non-financial assets. It is important to know kind of the different terminology that's used for these. So there's gifts in kind, there's non-cash contributions, there's in-kind contributions, donated services is another terminology used. And as far as financial statement reporting goes, the donation of services and donation of use of facilities, you are required to report those as contributions on the financial statements. And then, as Richard mentioned, they are reconciled out for the 990 reporting. And then he kind of covered a lot of the things that can be included as in-kind contributions. So I won't repeat those items. All right, let's go ahead. It's been a while since we did a poll question. Let's go ahead and do another poll question here. All right, so question number 2, not multiple choice. So does your organization receive donated services that qualify for recognition as a contribution? Okay. So I don't know if you guys see the responses, but I'll go ahead and let you know what I see. So it's about a third all the way across. So I'm guessing a third of us listening are Larson employees or do not work for a nonprofit organization. But yeah, so 36% said yes, 32% said no, and 32% said not applicable. All right, so as far as the recognition of gifts in kind goes, so you'll want to record your in-kind contributions that can be used or sold at fair value. And in determining fair value, you should consider the quality and quantity of the gifts as well as any applicable discounts that would have been received by the entity. So like including like if you get a discount based off of the quantity, if you purchase them, if you would get a discount on the quantity, you know, you can incorporate that into your fair value. As far as like the fair value when it's passed to a nonprofit from another entity, usually it wouldn't increase when it's passed on. However, it could increase if the entity adds value to the gift as part of the transition to the nonprofit, if that makes any sense, because they most likely have it on their books at fair value. And so if they were to do anything to enhance the value when they're transitioning it to the nonprofit, you would want to incorporate that into the value that it's recorded on the nonprofit's books. And then any contributions of services that create or enhance non-financial assets, those may be measured by referring to either the fair value of the services received or the fair value of the asset or the asset enhancement resulting from the services. So similarly, services should be recorded at a determined fair value. So that's kind of the recognition piece. And then as far as issues and challenges with in-kind contributions and why it's kind of a sensitive area. So a lot of financial statement users, whether that's agencies, donors, or regulators, they can be skeptical about the values recorded for in-kind contributions just because there's estimates involved in determining the fair value. So that's kind of what, because it's an estimation, that just automatically makes it more sensitive or risky. And then gifts in kind can often be subject to donor restrictions and legal restrictions. So similar to a cash contribution, a donor could restrict the use of an in-kind or non-financial asset that's donated. So that's also kind of a little tricky area. And then in some cases, the purchase of an asset may include an in-kind piece. So if because they're selling the item to a nonprofit, they're providing a significant discount, then there could be an in-kind piece to that purchase. So, if they would sell it to that amount to a for-profit entity and they're just selling it, even though it seems like it's discounted, if that's the market price, then it can be considered fair value. But if there's like hey, we're giving you this deal because you're a nonprofit organization, then there could be some in-kind considerations there. And then another thing that's kind of tricky with it is that a lot of nonprofit organizations, they're just not familiar with the market for certain types of gifts. Richard mentioned, having an in-kind gift policy, because there can be gifts that you receive that just aren't something you're familiar with, and you just don't really know how to determine the fair value of that gift. So that, being able to determine that fair value is kind of tricky. So that's just kind of a brief background for in-kind gifts. So let's talk a little bit more about the updates to the reporting requirements in the financial statements. So why was an update necessary? So we talked about some of the issues in the previous slide. So some of those issues are contributing to the need for this change. So, certain stakeholders or financial statement users have concerns regarding the lack of transparency into the financial statements. So, a lot of times on the statement of activities, the non-cash contributions are just lumped into the cash contributions, to where there's just one line item on the statement of activities. And so there's not that transparency there that's showing, okay, what of your contributions are non-financial assets. And then also current guidance has requirements for the recognition and initial measurement of contributions and disclosure requirements for contributed services. But there's not really any guidance for the disclosure of other types of contributed non-financial assets. So this the standards hopefully going to help with some of these concerns. All right, let's go ahead and do poll question number 3. All right, and this one is just kind of addressing something I just brought up. So historically, has your organization separated its in-kind contributions from its contributions on the statement of activities? All right, that was fast. Okay, so the results are 39% of you say yes, 26% of you say no, and then again, the 35% say not applicable. So as far as those where it's applicable, the majority are saying yes, but there is a big portion that says no. And so either way, it wasn't required in the past, so including them together with contributions was just fine. But so let's talk about the new standard and kind of the changes here. So to address the concerns we kind of just talked about, this new accounting standard update was issued. So ASU 2020-07, and it's titled The Presentation and Disclosure by Not-for-Profit Entities for Contributed Non-Financial Assets. So under the new standard, the contributed non-financial assets are required to be presented separately from other cash contributions on the statement of activities. So those that are saying yes for that, you will continue to do that. For those that say no, you'll need to implement the standard and break that out. And we'll go through some specific examples of how to do that. Okay. All right. So the other thing is that there's also going to be additional disclosure requirements for the footnotes. The disclosure of contribution types by category, disclosures of how contributions were used, and then additional disclosures regarding the fair value of those contributions. Let's quickly go through those 3 different types there. So as far as the contribution types, so you're going to be required to disclose those and those that have been recognized during the reporting period by category. So that can be donated services, goods or supplies, or property and equipment. And then a further breakdown is also required for the categories to kind of describe the types of those donated services provided. So for donated services, it could be legal, accounting, or other types of services. And once again, I don't know if I specifically said this earlier, but the types of services, those have to be provided by someone with a special skill. And so I think that's where the breakdown comes. So like a legal attorney provides services that's a special skill that they have that you would you'd need to pay for otherwise to get that service kind of thing. If contributed assets are received, the type of asset should be included. If it's a land, if it's building, vehicles, or inventory, you'll want to have that broken out in your disclosures as well. And that'll help out with a lot of the 990 reporting that Richard mentioned, and it'll help make the preparation of the 990 a little easier once the audit's performed and they have a set of financial statements to use. So for contributed non-financial assets that include a donor imposed restriction, a description of those restrictions should also be included in the disclosure, just to make sure that the financial statement users are able to understand the types of restrictions that apply to those contributions. And it's important to kind of include it in that same footnote, just so it's clear which assets have those restrictions to them. Okay, and then next is the use of contributions. So the standard aims at disclosing how the nonprofit uses its gifts in kind. So this was also something that hadn't been required in prior disclosures. So for example, if a nonprofit receives a donation of stock, but they do not maintain an investment portfolio outside of money market funds, then the nonprofit may have a policy to convert that stock to cash. And so that's something that you would disclose in the footnote. So the type of asset that you received was a stock. What you did with that asset was you converted it to cash. And so that just kind of explains what you're doing with those contributions. And I think it helps also to kind of see, if you do get a contribution of a non-financial asset that kind of doesn't fit with your organization and how you operate, it kind of shows, okay, how are you taking that unusual financial asset and converting it to something that you can use to fulfill your mission and what you do as an organization. And then also there are those contributed assets that can be used directly in program activities. So if you get supplies, medical supplies, clothing, accounting services, something that that's a program activity or a general and administrative activity, you can disclose how those non-financial assets were used in those areas. For the non-financial gifts that are being used during the reporting period, the disclosure should identify the programs or activities that those are used in. So, all right, and then if the nonprofit has developed a policy related to monetizing assets upon receipt, that policy can also be disclosed in the financial statements. So, for that first example, if you have a policy that you convert stocks to cash, and that's your monetizing of those type of assets, that's your policy, then that can be included in the disclosures as well. Okay. All right, let's talk a little bit about recording it, or I guess talked about recording at fair value, but now you're required to disclose that information on how you're recording it at fair value. So the valuation techniques you use to determine the fair value of those contributed financial assets, non-financial assets. So you'll be required to disclose those valuation techniques. And then also, when you're determining the market to be used in valuing those assets, There could be restrictions that are donor imposed that could impact why a certain market was chosen. So like as an example, if a nonprofit received pharmaceutical supplies that were restricted by the donor to be used outside of the United States, the market used to determine the fair value would need to be tailored to that restriction. So where it was a specific region where it's going to be used, you would probably want to use a region that's outside of the United States, or a market outside of the United States, to help determine the fair value for that contribution. Okay, let's do poll question number 4. All right, has your organization early adopted this standard? And the options are yes, no, not yet, but we are planning to, or not applicable. All right, so we have 14% say yes, they're early adopting this standard. 33% say no, and then 10% say not yet, but we are planning to. So about 24% of you out there are early adopters, and 33% are not early adopters, and then 43% were not applicable. So, all right. And I probably could have done this next slide before that question, but we'll be okay. As far as the implementation, we've got that FASB is requiring it to be applied retrospectively. So what that means is in the year that you adopt the standard, and if you have comparative financial statements, you will need to include the disclosures for both years. So it will need to be retrospective. And then the amendments, these take effect for annual reporting periods beginning after June 15th, 2021. So if your year end, or I guess if your fiscal year begins after June 15th, 2021, that will be the first year you are required to adopt the standard. And then early adoption is permitted. So those of you who said yes, you're early adopting, that's just fine. You can do that. All right, I do have a slide here to go through any questions so far. I don't believe I have any in the Q&A. But yeah, like I said, if you have any questions come up during the presentation or after the presentation, as you're thinking things through, feel free to reach out to Richard and I. Before we go through some examples, I figured we could go ahead and have a little break. We've kind of incorporated a 5 to 10 minute break. I think we can, let's plan on 5 minutes if that's okay. I don't think people need too big of a break. If you're, I guess if anybody has problems with 5 minutes, submit it to the Q&A now. But otherwise, let's start back up at 1:05. Okay. It's 1:05. That seemed to go fast for me. So, but everybody's probably here. There was a question that came through on the Q&A. I'll go ahead and talk about that one right now. So the question was, do you have any examples of how organizations are valuing contributed services from various professionals? What sources are they referencing? So I think the most common source I've seen referenced is if they've had to purchase those services in the past, they've been able to review or review historical invoices that they have that kind of provides a value for those services. If they haven't purchased those services in the past, there's also the possibility that they have a board member who provides those services. I know some boards we work with, they have attorneys on the board or they have CPAs on the board. And those board members can also be used as a reference as far as coming up with the value for their services. Sometimes you don't have either of those. I know that you could go out for a bid, potentially just kind of reach out to someone and try to get those. But those are some examples I've seen of what's been used. I can check with Richard as well, and we can get back to with any other potential options as well. Okay, so here's the fun part. The examples of financial statement presentation and disclosures. And this part shouldn't take too long, but this is also the last section we have. So we'll get up to the hour-and-a-half CPE, I'm sure. We're getting there. Okay, so here's an example of the statement of activities. And for the statement of activities, you do have two different styles that you're able to present. There's this example is I've heard it called the pancake style. It's the only one I can think of. There's probably other ways to describe it. But essentially, this is one column format to where the changes in net assets without donor restrictions are in the top section, and then the bottom section is the changes in this net assets with donor restrictions. And so in this example, and like the poll said, most of you are already doing this to where you're breaking out the contributions by financial assets and non-financial assets. So here in the past, there was just the one line for the contributions, which is now crossed out. And then you have the two lines of contributions of cash and other financial assets, and then contributions of non-financial assets. And also, another thing that this helps out with that I haven't really addressed yet is the cash flow statement, because historically, you would have had to break these out on the cash flow statement anyway, because they are non-cash items. And so essentially, this is making it so the information on the statement of activities is also going to tie out to what's on the cash flow statement, because you would take your changes in net assets and reconcile out those non-cash contributions. And then in the bottom section here, you do also want to break it out in the changes in net assets with donor restrictions. So you would want to break out your contributions of financial assets and your contributions of non-financial assets. So this one's pretty easy, mostly because a lot of people are doing it. Here's another example of the statement of activities. This one is the column format where you're breaking out the donor restrictions and without donor restrictions and with donor restrictions into separate columns. So in this case, you're reporting the same information, but here it's just on one line, and then it's broken out in the columns if it has a restriction or not. And so same thing, there was the one line for contributions, and now there's the two lines that show those contributions. Okay, so that's the statement of activities. Like I said, pretty straightforward and pretty easy to follow. It's the footnotes that are going to be fun. Okay, So last polling question that we have for you. Let's go ahead and get that up. All right, this is not really in-kind related, but how does your organization present restrictions on net assets on the statement of activities? We use column presentation or we use the pancake presentation, or not applicable? Okay, so the results are in, and 45% use the column presentation, 5% use the pancake presentation, and 50% are not applicable, which that just means that there's a lot out there that don't have donor restricted net assets to where they don't have to have the column or the pancake. Yeah, okay. So let's get into some footnote examples. Okay, this first example is kind of two-part. So there's this table here. So it's a footnote specifically for your contributed non-financial assets. And what this one does is it's breaking out the dollar amounts by year, and then it's breaking it into its different categories. So the total of these categories in 20x9, the 1.2 million, that would be the amount that would tie out to your statement of activities of non-financial asset contributions. But then this breaks it out by the different categories, different types of contributions received. And then the next slide here. So if you present the table that way, you still need to have the wording requirements. So in this example, this first one, I'll just go ahead and read it. But so not-for-profit K recognized contributed non-financial assets within revenue, including a contributed building, vehicles, household goods, food, medical supplies, pharmaceuticals, clothing, and services. Unless otherwise noted, contributed non-financial assets did not have donor-imposed restrictions. So that's meeting that requirement where you are required to disclose if there are any donor-imposed restrictions on those assets. And then here it is NFBK's policy to sell all contributed vehicles immediately upon receipt at auction or for salvage unless a vehicle is restricted for use in a specific program by the donor. No vehicles received during the period were restricted for use. All vehicles were sold and valued according to the actual cash proceeds on their disposition. So that's disclosing what they did with that asset. So they were sold and valued according to the actual cash proceeds at the disposition. And then the contributed building will be used for general and administrative activities. In valuing the contributed building, which is located in Metropolitan Area B, not-for-profit K established the fair value on the basis of recent comparable sales prices in Metropolitan Area B's real estate market. So there, that one's disclosing how the fair value was determined. And then also what that building is used for. So these three examples are kind of taking, the top one is showing, okay, were there any donor restrictions? And then these next ones are going through the different categories and they're explaining how the value was determined, what they used the assets for. And so they're meeting those disclosure requirements. And so this is just more examples of just the verbiage that's used for the different types of assets. So the contributed food, just the programs they were used for. In the second bullet point there, any pharmaceutical supplies, what those were used for. And then the contributed services down at the bottom and just kind of how those were determined. So that's one approach. This morning as I was going through, I'm going to improvise here a little bit. This morning as I was going through the slides, I found that some slides I prepared for another option for disclosure weren't included. So I'm gonna pull that up here, and hopefully you can see this on my screen. But this is another option to follow. And so this table, so this is just taking kind of the same information, but rather than having it, you know, the dollar amounts in one table, and then underneath that table, kind of having the descriptions. So this example is taking the table, the amounts, but then also putting in columns that describe how they were utilized, if there are any donor restrictions on them, and then just evaluation techniques and inputs used. So either of these would be acceptable to use, whether you do the table with just the numbers and then kind of the descriptions, or if you follow this example and kind of put it all into a table that has all the requirements in the columns that disclose the information you need to disclose to meet this new standard. The one thing about this format here is that you do need to have it for both years. So you would need to figure out if you want to do one table for 1 year and one table for the prior year, or if you would like to somehow incorporate both years into one table, which might be difficult if you have different types of contributed non-financial assets each year. If you're getting the same contribution year after year, so if you, let's use rent for example, if you don't pay rent but it's donated to you by the landlord, then that's something that's going to be consistent year after year, to where you could probably put that in a table like this and have the dollar amounts for each year in that same table. But if it's something different, then it's kind of more difficult to kind of incorporate a dual year presentation. So this is something that you can work with your auditors on. If they help you present your financial statements, then you would want to just kind of talk with them and see what you prefer, whether it's this table format or the more paragraph format describing things. And I'm sure your auditors will be able to work with you and figure out, you know, if it's us, we'll figure it out with you and determine what's best for you and what presentation you like best. And then usually, like with these type of things, it's kind of, you figure it out as you go, determining what you like and how you prefer to read it. So, you know, the first year you may do it one way, and then it could be adjusted in subsequent years to kind of better fit what you like or what your financial statement users like. So yeah, those are kind of two examples. And I'll get that out of the way. Hopefully you were able to see that. If you weren't, sorry. Okay. Last slide. I haven't seen any other questions come through. But if you do have any other questions, feel free to reach out again. The slide has, there we go, mine and Richard's information, our website's information. If you have any, if you want to look into us a little bit more, if you have any questions for me or Richard, feel free to reach out to us. We can provide these slides to those people who have participated in the presentation. We can email these out, and I'll add those to that last example I went through. I'll add that to the slides before we send those out. But yeah, that way you can have that as a resource to use. If there aren't any questions, I think we have met the hour-and-a-half requirement, the 50 minutes and then the 25 minutes. So we should be good there. Thanks again for listening in, and hope you guys have a great day. Thanks.